Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Applied Optoelectronics.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for investors who want a faster and cleaner research workflow. You can check out stockanalysis.com Pro through the link below in the description. Use discount code ITP for 10% off. Stockanalysis.com is lightweight, fast, and works on desktop, iOS, and Android. The free version is useful for checking stock prices, financials, charts, forecasts, and news. But if you want deeper research, stockanalysis.com Pro gives you no ads, saved screeners, watch lists, portfolios, long-term financial history, dividend history, analyst filters, ETF data, and exports to Excel, CSV, and Google Sheets. Pro comes down to about $5.93 per month when billed annually after the discount. For heavier users, the unlimited plan adds unlimited downloads and unlimited stocks per watch list, and comes down to about $14.93 per month when billed annually after the discount. StockAnalysis.com is a research tool, not financial advice. It does not tell you what to buy or sell, and it does not guarantee investment results. Always do your own research and make your own investment decisions. This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
So what if I told you that the absolute biggest bottleneck in this multi-trillion-dollar AI revolution isn't actually a microchip,
Right.
and it's not the power grid either. It's actually a tiny, highly specialized laser.
Yeah, that's crazy to think about.
It really is. Today, we are looking at this legacy company that has surged an absolutely jaw-dropping 848%. I mean, they've outpaced mega cap market darlings, companies like Micron and Dell.
Oh, easily.
And they did it by just quietly morphing from this standard telecom supplier into an absolute titan of AI infrastructure.
It is honestly one of the most remarkable transformations we have seen in the market this year, frankly.
Yeah.
They've essentially positioned themselves right at the center of the whole artificial intelligence boom. But, whenever you see a stock go almost vertical like that on a chart, it demands a massive amount of scrutiny.
Oh, I couldn't agree more. For anyone managing their own capital, that is the single most critical question you have to ask when you see an 848% run. Are we looking at a speculative AI bubble fueled by pure hype? Or is this company genuinely the physical bottleneck of the entire global AI build-out?
Exactly.
And to figure that out, we really have to understand where they actually fit into this technological revolution.
All right, let's move into the wealth building context.
So to see why this company actually matters for a long-term portfolio, you really have to look past the sort of surface-level AI software hype.
Yeah, the chatbots and all that.
Right, exactly. This isn't a company building language models or coding assistants. This is a pure-play AI enabler.
Yeah.
It is the classic picks and shovels investment.
Mm-hmm.
In any gold rush, the surest way to build wealth isn't guessing which prospector will find gold. It's selling the pickaxes to all of them. Because, well, they all need tools. Okay, I like the picks and shovels analogy, but let's take it a step further because this is way more advanced than a basic tool. We are talking about optical interconnects here.
Exactly. So think about these massive data centers, right?
Yeah.
The hyperscalers. They are out there buying billions of dollars worth of incredibly advanced AI processors. But here's the catch. To train a modern AI model, you need thousands of those processors working on the exact same problem simultaneously.
Right, in parallel.
Yeah. And they have to shuffle massive amounts of data back and forth constantly. So if you think of those AI chips as giant, bustling skyscrapers full of workers, the optical interconnects are the high-speed rail lines connecting them.
Right, you can build all the giant skyscrapers you want, but if the workers are stuck in bumper-to-bumper traffic trying to get between the buildings, the whole city just stops.
Literally grinds to a halt.
Yeah, the expensive processors just sit there, idle, waiting for data. It's a massive waste of capital for these tech giants.
Which brings us to exactly what this company builds. They build 800G and 1.6T optical transceivers.
Stop right there for a second. Let's just break those terms down for you listening because it sounds like alphabet soup.
Sure. So the G stands for gigabits per second, and the T stands for terabits per second. So an 800G transceiver moves 800 gigabits of data every single second over a fiber optic cable.
Wow.
And the 1.6T moves 1.6 terabits. We are talking about speeds that were essentially science fiction just a decade ago.
Yeah.
And at those speeds, copper wire is just useless because it generates way too much heat and signal loss. You have to use light. You have to use lasers. If this data cannot move fast enough between the server racks, a multi-million-dollar AI cluster becomes completely bottlenecked.
And from a wealth building perspective, owning the bottleneck is how you capture true pricing power. As an investor, you want to own the toll booth on the only highway into town.
Absolutely.
And if they really are the only highway, the financial results should reflect that, right? Now let's look at the fundamentals.
Well, the numbers here are completely shifting the paradigm for this business.
Mhm.
They recently posted record first quarter revenue for 2026. But the real headline, the thing really driving the massive stock performance, is the forward guidance. Management is guiding to over $1.1 billion in fiscal year 2026 revenue.
Which is just a huge jump. And a lot of that is being driven by a shift in their product mix, right?
Right.
They are moving away from the cheaper legacy telecom parts and moving aggressively into those higher speed, premium 800G and 1.6T transceivers.
Yeah, the high margin stuff.
Exactly. Because these are cutting-edge premium products, the profit margins are significantly higher, so they are getting massive operational leverage. But honestly, as I was digging through the transcripts for this, there was one specific detail that completely stopped me in my track.
Would you talk about the demand cap?
Yes! Wait, let me just physically lay out this math because it completely changed how I view this stock. That $1.1 billion revenue guide, it's artificially low.
Yeah.
The CEO, Thompson Lin, actually revealed that the true market demand from their hyperscale clients is sitting between $1.4 and $1.5 billion. The only reason they are guiding for $1.1 billion is literally because their factory walls aren't wide enough.
They just physically cannot manufacture the transceivers fast enough to meet the demand.
Right. They have tech giants waving $400 million in cash at them, and they're essentially having to say, please hold, we're building as fast as we can.
It is the ultimate good problem to have, really. It proves an incredible product market fit. But you're right. It means they're leaving massive revenue on the table. You have to spend money to uncap that bottleneck. And to be fair, they are actively doing that. They are taking their substantial operating cash flows and aggressively reinvesting it into capacity expansion.
Right, and we should contextualize their valuation while they do this because they are currently trading under 10 times next 12 months, or NTM sales.
Which is wild.
It is. For context, pure-play AI infrastructure companies with this kind of growth often trade at 20 or even 30 times forward sales. So sitting under 10 means the market still has a bit of a legacy telecom hangover and hasn't fully priced in this new hypergrowth reality. But my skeptical side immediately asks, if demand is really outstripping supply by $400 million, why aren't competitors just flooding the zone and eating their lunch?
Well, that comes down to their competitive moat, which is built on highly specialized intellectual property. They are vertically integrated in something called indium phosphide and silicon photonics.
Let's unpack the indium phosphide part, because this is really where the magic actually happens. Look, most of the tech world runs on silicon. Silicon is amazing for computing, but it is terrible at emitting light.
Right.
Indium phosphide, on the other hand, is phenomenal at emitting light, which makes it the ultimate material for these high-speed lasers.
But it is incredibly brittle.
Exactly. It is famously difficult to manufacture at scale without the materials just cracking or failing quality control. Because this company is vertically integrated, meaning they control every single step of the process, from the raw materials up to the finished transceiver, they have mastered the manufacturing of indium phosphide. They don't have to rely on third-party suppliers.
And that vertical integration creates massive switching costs. Imagine you are a tech giant. You are spending $10 billion on an AI training cluster. You finally validate a supplier whose ultra-high-speed lasers actually work reliably without burning out.
Yeah.
Are you going to risk switching to an unproven competitor just to save a few pennies per unit? Absolutely not. You lock in your supplier.
You really do. But capturing that locked-in demand requires building out their production lines fast, which naturally leads to upcoming events. That brings us to the catalyst timeline.
So over the next few months, the primary focal point for the entire market is going to be their Q2 2026 earnings, which we expect around late July or early August. Wall Street isn't just going to be looking at the standard profit and loss numbers.
No, not at all.
Everything will hinge on management's update regarding that capacity expansion. Investors want proof that the physical bottleneck is being uncapped so they can get to that $1.5 billion demand figure.
Right. And alongside the earnings, you have to watch the industry events. There are major optical networking conferences coming up. These specific trade shows are typically where companies announce new product milestones for 1.6T technology or reveal massive new design wins with hyperscale clients. A major contract announcement at one of these events could act as an immediate upside trigger.
We also have huge macro tailwinds at our backs here. The broader economic conditions are favoring this setup. The capital expenditures, the capex from giants like Microsoft, Meta, and Google are continuing at a relentless pace.
Just billions and billions.
Exactly. And as long as those hyperscalers keep writing checks for AI infrastructure, the structural demand remains locked in. Plus, we're looking at a macroeconomic environment where potential Federal Reserve rate cuts are on the table.
And rate cuts disproportionately favor companies exactly like this. Look, this stock is part of the Russell 2000 index, which tracks smaller companies. It's what analysts call a high beta growth stock.
Hmm.
High beta simply means it moves with exaggerated volatility compared to the broader market. When interest rates drop, money flows into riskier, high growth, high beta assets, which acts like absolute rocket fuel for their valuation multiples.
There are also speculative catalysts we really need to talk about. When a company is sitting on $400 million of unmet demand because they just need more factory space, the obvious financial move is a secondary stock offering to raise capital.
Okay, I have to push back here. My analytical side sees a secondary offering as a highly bearish event. It's dilutive. You are issuing new shares, which waters down the value of the shares existing investors hold. That usually causes a stock to tank.
I mean, in 90% of cases, I would agree with you. But in this specific hypergrowth context, the market might actually reward a capital raise. Think about it. If issuing new shares means instantly unlocking the facility capacity to capture $400 million in excess demand, the revenue growth would far outpace the dilution. It accelerates the fundamental bull case.
That's a fair point if they can deploy it fast enough.
Exactly. We also can't ignore the ongoing rumor mill. As a small-cap leader holding critical intellectual property in 1.6T optics, they are a glaringly obvious M&A target mergers and acquisitions. Larger networking conglomerates might decide it's just cheaper to buy them outright rather than trying to compete in the indium phosphide space.
Yeah, and all of these catalysts are feeding into incredible momentum on the price chart. Now let's pivot to the chart.
When you look at the technical price action, the psychological state of the stock is defined by explosive breakout momentum. It has surged to multi-year highs. This is classic power trend behavior.
I'm looking at this chart, and an 848% run just screams caution to me. What exactly defines a power trend here?
So, a power trend is when the institutional buying pressure is so relentless that any minor dips or pullbacks are aggressively and instantly bought up by the market. The stock just refuses to stay down.
Okay.
We saw a perfect example of this on June 2nd. It was a leading upside gainer on a very strong day for the broader NASDAQ. The volume of shares trading hands is incredibly heavy, and the momentum mirrors the broader run we are seeing in AI-linked small caps across the board.
It is undeniably strong, but as an investor, you have to manage risk intelligently here. I want to cautiously unpack this. A lot of this trading flow is being driven by FOMO, the fear of missing out. Retail investors see an 848% run, they read AI, and they just jump in blindly. Vertical ascents in a stock chart bring extreme heightened volatility.
Oh, definitely.
When a stock gaps up aggressively day after day, it often needs to violently retest its structural support levels. You have to be prepared for wild intraday price swings. If you don't have the stomach for that, you'll get shaken out by what is actually completely normal technical consolidation.
Well, Wall Street is certainly noticing the momentum. So what does market sentiment look like?
In a word, aggressively bullish. The narrative has completely shifted. The market has entirely decoupled this company from its past as a cyclical legacy telecom supplier. They are now viewed strictly as a pure-play AI infrastructure enabler.
And it's not just them either. The entire sector is getting validated. Look at their competitor, Lumentum. Morgan Stanley recently gave Lumentum a massive price target raise, up to $595.
Which is actually fantastic news for Applied Optoelectronics. When a major firm like Morgan Stanley raises targets on a direct peer, it validates the pricing power and the insatiable demand across the entire high-speed transceiver sector. Analysts are looking at the situation, and they aren't seeing the supply constraint as a failure of management.
No, not at all.
They are treating it as the ultimate flex. It is tangible proof of market dominance.
You also have implied strong institutional accumulation. When you look at the 13F flows, which are the mandatory quarterly reports that big institutional investors and hedge funds have to file, it shows smart money is actively chasing this exact bottleneck narrative. They are quietly accumulating shares.
But even the smartest money gets it wrong sometimes. A bull case is only as strong as its ability to survive a stress test. Now let's talk about the risks.
The absolute biggest threat here is execution risk. The entire bull thesis relies on flawlessly scaling their manufacturing.
Right. Going back to our earlier metaphors, designing the ultimate high-speed rail line is great, but if the tracks warp when the train hits 200 miles per hour, it doesn't matter how brilliant the design was. Scaling up indium phosphide manufacturing is notoriously difficult.
Yeah, it all comes down to something called yield. In optical manufacturing, yield is the percentage of lasers that actually pass quality control and can be sold. If they hit supply chain snags or if they have operational bottlenecks on the factory floor, their yield could drop.
Which would be disastrous.
Completely. If they're throwing away 40% of the lasers they build because of defects on the new 1.6T lines, they won't be able to capture that excess demand. If the market senses they can't scale efficiently, this premium valuation multiple will crash instantly.
There's also macro cyclicality risk. We have to ask the hard question, what happens if the hyperscalers suddenly decide to slow down their AI spending? The broader technology sector is still vulnerable to rising inflation or sudden spikes in treasury yields. Historical sell-offs tell us that high-flying, high-beta growth stocks get hit the hardest and fastest when macro shocks occur.
That is true, but I will balance that caution with a mathematical reality here. Because their true demand is roughly 30% higher than their current physical capacity, they actually have a built-in shock absorber. Even if the broader AI market cools down slightly and hyperscaler demand drops a bit, they still have a massive backlog to chew through before that slowdown ever impacts their guided bottom line.
That's true.
They are buffered against minor cyclicality.
That is a critical point. The demand is so outsized that a slight trim doesn't actually derail the revenue trajectory. So with everything on the table, what's the final verdict?
We're looking at a highly asymmetric long opportunity. You have a company conservatively guiding for $1.1 billion in revenue, trading at a relatively cheap sub-10 times forward sales multiple for the AI space, with a confirmed actual customer demand of $1.4 to $1.5 billion backing it up.
It is incredibly rare to see a structural bottleneck this clearly defined and admitted to in a hypergrowth sector. Based on the massive fundamental backlog, the defensive moat built around indium phosphide manufacturing, and the unstoppable global AI infrastructure tailwinds, the official bullish score for this stock is a 9 out of 10.
And regarding the target horizon, we view this firmly as a multi-year hold, specifically looking at a 1 to 2 year time frame.
Yeah.
The global deployment cycle for 1.6T optical transceivers is really just getting started.
Before we wrap up, let's just circle back to the very premise of this shift. We talked about this company being the literal high-speed rail lines of the AI build-out, the bottleneck, where data either flows at the speed of light or gets completely choked.
Right.
We are obsessing over 1.6 terabit speeds today, but AI models are growing exponentially in size and complexity. In 2 years, 1.6T might look like dial-up internet.
Wow, yeah.
The provocative question you need to ask yourself as an investor is this. What happens to a company's pricing power when they are the only ones capable of building the next generation of speed?
And the cycle of innovation never really stops. It just demands faster highways.
If you want to build a cleaner stock research workflow, you can check out stockanalysis.com Pro through the link below in the description. Use code ITP for 10% off. Pro comes down to about $5.93 per month when billed annually after the discount, and Unlimited comes down to about $14.93 per month when billed annually after the discount. Remember, stockanalysis.com is a research tool, not financial advice. It does not guarantee investment results, and you should always do your own research before making any investment decision. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.